In a world where that growth exceeds all economic growth, it's basically a game about liquidity. Therefore, I'm super happy to have the master of liquidity here, Michael Howell from CrossBorder Capital. I'm very happy and pleased to have you, Michael.
Well, I'm very pleased to be here. Looking forward to it.
Perfect. Maybe for all the people that don't know about you yet and that don't really understand the concept of liquidity yet, can you maybe briefly explain what is global liquidity and why does it matter?
Yeah, sure. Global liquidity is probably the paramount thing that investors need to understand in terms of what drives markets, asset markets, and ultimately economies in the current world. And the whole concept was really something that we've devised over the last 2 or 3 decades. It's been a significant factor behind markets. And I wrote a book in 2020 called Capital Wars, which essentially outlined the whole process of what global liquidity is and what it means. And effectively, it really comes down to sort of 3 things. One is that geopolitics is really being fought out increasingly in financial markets. And what that really is saying is that the struggle for the control of world money is a geopolitical event, and we need to understand the forces that are really acting on that. So financial markets are really the battleground for that geopolitical trend or theme. The second thing is that in the book, and this was written just before the COVID crisis, we said then that government policy, government spending was likely to be a major factor driving liquidity in markets. In other words, governments had to fund themselves, and what you were likely to see was more and more printing of money, if you like, to finance large government deficits. And the third thing was that if you look at those liquidity flows were likely to override traditional fundamentals and be the major factor driving markets. And liquidity defined is the flow of money, in factual fact, credit and savings, to be accurate, through all world financial markets. It's not a concept like M1 or M2 that is much more a sort of measure of retail money in bank deposits that flow in the real economy. This is much more a financial focused concept.
Well, and basically you show as well in your liquidity analysis, in your correlation analysis, that basically liquidity is the main driver of most risk assets like Bitcoin. We all know that correlation does not equal causation. So, like when you make those tests, how can you actually prove that this is not a coincidence, but it's really liquidity driving the markets?
Well, I suppose there are 2 answers to that. I mean, one is that we do a lot of very rigorous statistical testing. So we look at the data intensively and we try and work out whether there are lead times and patterns in the data. So I think that's one thing to say. But the other thing is just basically, I'm still here. I'm still talking about these things. I've been doing this for 20, 30 years about the same concepts. And if it was completely bogus, I'm sure that people would have worked it out by now. So the reality is that this is what drives markets. We've been saying, certainly since late 2022, that we were entering a major bull market for assets worldwide, simply because the flow of liquidity into financial markets was rising, courtesy of the central banks. And I'm more than happy to drill into the data and give you some insight into that.
Yeah, I'm actually very thrilled because since I discovered the concept of liquidity, so you have my background as well. I got into crypto very early and I made a lot of money with it and I didn't understand why. And since I know what's going on within the system and that the system is kind of broken and they have to fix it and the liquidity increases as kind of the collateral damage or crypto prices skyrocketing and so on, it's kind of the collateral damage we pay. I understand it and I made so much money with it. But my question to you is then do you think big players understand it too, or how come that they don't, and why does not everybody talk about it? Why is there still so many people who are kind of ignorant to the facts?
Well, it's a very good question. I think it's difficult to answer that. I think one of the reasons may be inertia, that people don't really understand what drives financial markets. And if you pick up a finance textbook is absolutely useless in I would argue, in telling you anything about how financial markets operate and tell you anything about how to value securities or whatever. And that's the reality. That's the plain fact. I mean, one of the, give you one example, for as long as I've been in the financial industry, which is over 30 years, the one major tenet is that people should buy low PE stocks. They should be value investors. Well, that's had a terrible, terrible track record in terms of making or losing people. It's actually been very successful in losing people a lot of money. Low PE stocks don't always go up. It's not about value. It's about effectively the flow of money that's coming into markets. And the reality is that you, I, or anyone else makes their decisions in financial markets about their liability structures. And those liability structures can be summarized in terms of a time horizon. So in other words, I may have a time horizon in my investment of 5 years. You may be longer since you're younger. You may have 25 years. But effectively what you're doing is you're trying to invest over a certain time horizon. And that is can be measured by a concept called duration, which is a financial market concept. It's the average time horizon you invest over. Now, if you think about what liquidity is, or plain and simple cash, is a zero duration asset. So if I've got a target duration of, let's say, in my case, 5 years, and I suddenly get cash dumped on me, courtesy of the central banks in aggregate, then my duration on average is going to be below the 5-year target. So I'm going to have to buy more assets to get to that target. And what I'm going to likely buy are longer duration assets. Now, in extremis, which are the longest duration assets? Anything with a very high PE, like a technology stock, or Bitcoin, which has probably got infinite duration. But if I want to increase the duration of my portfolio, then I'm going to buy those assets. So if there's an abundance of liquidity in the system, what happens is that high PE stocks like technology stocks or high long duration assets like Bitcoin or gold tend to be bought. And that's the reality. If you get a tightening of liquidity, then duration horizons will shrink and you will get the reverse happening. So it's a question of understanding that cycle. And that's why picking up a finance textbook won't help you, because it won't tell you anything about these macro forces that are really driving markets. Now, there are a lot of people who understand that. The central banks understand that. The US Treasury Secretary Scott Bessent understands that. He's very keen on managing liquidity in the US system. Just by looking at the evidence in the last 6 months, you can see that. Famous investors like Stan Druckenmiller, who's probably the most successful investor over the last 30 years, is wedded to the concept of liquidity. So certain people do, but I think if you talk to academics, they certainly don't. Or if you you talk to value investors, traditional value investors, they don't. The thing is, they're seduced by the whole idea of value, and value may work in certain instances, but it doesn't work in the macro sense.
Yeah, and I think like especially in investing where there's a lot of people with glasses and academics who think they're very smart and they want very complicated theories. And basically your liquidity framework suggests that when liquidity is increased, you should take more risk. And when liquidity is decreased, you should reduce risk. And that's actually pretty simple. And there's like a lot of people don't like simple things because they want to be smart and like complicated things. To be honest, I like things that work. And in the last years, your liquidity frameworks work perfectly. So we heavily rely on them. Maybe let's get into the details. Where do you see liquidity heading in the next 3 to 6 months? Because there's a lot of debate right now with the TDA that maybe it needs to be refilled and so on. That could drain liquidity. Then, of course, there's the redebt financing of the debt in the United States, the whole world. There's China. There's Europe, who's now spending money they don't have in order to intensify the war efforts and to spend on defense spending and so on. So what is your current liquidity outlook for the next 3 to 6 months?
Well, I think it's very important up front to say that you've got to distinguish the cycle from the trend. And what I'm going to say, probably in a sort of later part of this discussion, is that the trends are very important. And what we're looking at is a situation where debt, which is a paramount factor in financial markets right now, is likely to escalate in size significantly. Now, financial markets are all about refinancing that debt. Something like 80% of transactions in global financial markets are debt refinancing transactions. They're not about new capital raising. That's what the textbooks tell you is happening, but it isn't. No one's doing CapEx. What they're doing is they're refinancing their debt. If you want to refinance debt, you need liquidity to do that. So debt and liquidity in the long term have got to grow together. And if liquidity is expanding over that medium term or long term framework, you've got to invest in assets that are liquidity sensitive. Period. That's it. Okay. So that means you've got to have gold, you've got to have precious metals, you've got to have Bitcoin, and you've got to have high quality growth equities in your portfolio. You don't really want government bonds. And that's the long-term trend. In terms of the cycle is clearly a different question. And we've had something like, 35, 36 months of a bull market already. And it's, inevitably is getting mature. At some stage in the next 6 to 12 months, I think that's going to turn. I think the catalyst for a turn may well be a significant pickup in debt refinancing, as debt that was termed out during the COVID crisis is coming back for refinance, and that starts to pick up significantly next year. So that could be a factor. Another factor that I think is very significant and is been underplayed is that if you look at one of the major sources of cash flow from corporations in the US in the last 5 years, it's been the major technology companies. They have been huge cash generators. What is going on at the moment in America is a massive investment boom in AI and infrastructure. And they are spending something like $1 billion a day, right? So if you aggregate that over 2 to 3 years, you're talking of $1 trillion of money spent that is coming out of financial market liquidity pools and going into the real economy. That is likely to sap liquidity, and it's something we can't ignore. So these factors are significant to look at. And then you rightly cited what's happening with the US government and the Treasury General account. Now, that's a fairly wonkish concept, but what that's saying is the government wants to build up a cushion of extra cash in its bank account. And to do that, it will be absorbing money out of financial markets. And a lot of people are concerned that that may take up to 500 billion out of money markets. Now, I'm more optimistic on that particular angle because I think the Treasury and the Federal Reserve are very alert to liquidity questions. And I don't believe it's going to be as bad as that. But, if it is, I'll come quietly and say it's a negative factor.
Well, so on the one hand, we have this big capex spending. We have this big AI boom. Technological companies just spend all the money they have because they hope for bigger returns in the future. I think this is a little bit like in the times of the dot-com bubble that you might have experienced yourself. The difference, of course, is that in the old days, companies didn't really make money. Now those big companies are generating a lot of money. But I think if one thing has the potential to build a kind of super bubble, it must be AI, because the narrative is so strong. And I would expect at some point that they overshoot, that they invest too much, and then the returns from AI is way too little. And then we have a corrective thing there. But I think let's talk more about the government debt. So the United States, they have to refinance a lot of debt. And we have those 4-year cycles. Now, Janet Yellen started to issue a lot of short-end debt by issuing a lot of bills. As Scott Bessent first said, that's not good, we shouldn't do that, but now he ends up doing the same thing. So do you think there's a possibility that the whole nature of the cycle changes, that we don't have 4-year cycles anymore because the debt is due every year because of the issuance of the bills? Or do you think the effect is not as strong enough?
Well, I think it could change, and I think you raise an important point, because what we're moving to is a world where we're moving away from a world where the Federal Reserve has undertaken QE to a world where the Treasury is really engaging in QE, quantitative easing, because by changing the tenor of its debt issuance from very long maturity to very short maturities, they are basically changing the duration mix of assets in the private sector. And that is equivalent to a liquidity boost. So think of that as Treasury QE, and that's beginning to step up. Now, is it going to change the cycle? Well, let me maybe turn to some charts, and if you can put the charts up, I can try and right. Okay, so if we come back to what liquidity is and why liquidity is growing, what you can see on the chart in front of you is basically a slide that is looking at the path of global liquidity, which is the orange line. So this is the growth rate of a dollar aggregate of world liquidity. And the black line is the return on all financial assets. So this is basically confirming the fact that over time, the liquidity cycle, the orange line, the movements of that, are driving asset returns. And asset returns here includes everything. So it includes precious metals, it includes cryptocurrencies, it includes all bond returns, it includes all equities worldwide, it includes cash, liquid asset funds, it includes residential real estate. So everything is thrown into that mix. And liquidity is the paramount factor in driving that. Now, what is liquidity? I've probably given you a brief description, but here is a more formal one, but basically says that liquidity is a measure of balance sheet capacity in the financial sector, and it's something like $185 trillion of money that effectively can move around the world. It's more than 2/3 bigger than global GDP. Now, in terms of understanding this chart here, this pyramid chart or inverted pyramid, is really trying to understand what are the basics of that liquidity pool. The liquidity pool is shown at the top of the slide, 185 trillion, and it's an inverted pyramid. And the apex or the base of that diagram is basically showing you two major things. I'll forget the cross-border flow. One is central bank money, which is essentially central bank balance sheets, which is the amount of money that central banks control. And the other is collateral. Collateral is things like, in the case of a home mortgage, residential real estate, or in the case of most financial transactions, government bonds, so US treasuries or German bunds. And collateral, the pool of collateral, is critical because something like just under 80% of all lending worldwide is now collateral backed in some form. And this is a big change since the global financial crisis. So stability in collateral markets is absolutely essential to understand. And that is one of the things that the US Treasury understands, I think, fully. They want the US Treasury market to be stable, and that's something we've got to start thinking about. The pattern of liquidity is shown here in this chart. Now, you cited a 4-year cycle. I've never really found a 4-year cycle, certainly in terms of aggregate assets, but we have found a 5 to 6 year cycle, which is this one here. This data is showing the index of liquidity, which is a momentum index of the growth in liquidity globally, going all the way back to the mid-1960s. The Foundation for the Study of Cycles, which is an independent organization, took the data away and did their own independent analysis using more sophisticated algorithms than we have. And they came back with exactly the same result, that what you're looking at is a 65-month dominant cycle in that liquidity data. The sine wave that you see there is that 65-month cycle. We originally estimated that in year 2000. So it's had 25 years of real-time unfolding. So what you see is what you get. And that's, it's probably fair to say it's precisely wrong, but it's approximately right. And where we are now is in an absolutely pure upswing of that cycle. We're nearing the top, but that's where the cycle basically is evolving. And you saw the bottom of that cycle in late 2022. What is driving the cycle are central banks. These are the individual liquidity impulse cycles for the major central banks. You can see that everyone is largely moving together right now. So there's no hint of tightening coming, although one has to expect at some stage that what goes up comes down, because we're talking about a cycle. And that is likely to be triggered by inflation fears. But inflation fears would be really, I guess, on the back burner for many policymakers right now. They really want to try and revive economies first. Now, talking about the length of the cycle, this is the average length of a cycle shown as the black dotted line. You can see how this evolves over time. The trough of the cycle is drawn at the 0 point in the middle of the chart, and the red line is showing the current cycle. So you can see that we are mature in that particular evolution. It's not ending yet, but it's getting late, and one has to say. This is where we think we're going. We think the nearest parallel is the mid-80s cycle. That saw a trough around about the mid-1980s, and it was coincident with the Plaza Accord, which was an attempt to get the US dollar down. Now, the Plaza Accord sounds rather like the Mar-a-Lago Accord. It has the same word, accord. When policymakers use the word accord in currencies, they tend to mean that you're looking at something like at least 10% adjustment coming. And that maybe is what we're getting. Now, what ended the cycle in the 1980s was inflation. And at the time, in the middle of 1987, or getting into the early fall of that year, the Americans wanted to cut interest rates further. But the Bundesbank said, whoa, wait a moment. We think we've got an inflation problem, and we're rather inclined to increase interest rates, not cut them. That spooked the markets. They realized that the liquidity cycle was likely to come to an end. Even though Germany didn't go through with the interest rate increase at the time, the sentiment changed dramatically. And you can see how liquidity fell precipitously through 1988. But the markets had really woken up to that in late 87 already. So you can see the evolution is maybe similar to what we're looking at. And that's why we've got to be alert to factors like rising inflation, funding problems, etc. upcoming. Now, I'm just going to skip over this and look at this chart, which is one that you cited, which was the evolution of QE in the US. And this is showing the various sources of stimulus and really what's happening in the next few months. Now, the black area is what we can think of as Treasury QE. The red area is traditional QE by the Federal Reserve, in other words, balance sheet expansion. And the orange is what I've called not QE, which is a flippant way of saying this is a hidden stimulus that they weren't fessing up to at the time, but they were actually injecting money secretly into markets. And if you look at the evolution of those factors, you can see the range of stimulus. So it was really a large amount of stimulus came into markets through 2023 and early 24. That has come out a little bit now, but it's slated to go up. And the major driver is not Fed QE, and it's not really this hidden not QE. Those are things like the Treasury General Account and the reverse repo, which have been run down. But it's the black area, which is what I call Treasury QE, which is the slanting of issuance very much towards the short end in terms of bill finance or short-dated notes. Now, the reason that's important is that is who buys that is traditionally the banks. If you've got a very loose fiscal policy, which America has, bank balance sheets are expanding with more bank deposits from government checks, and the banks have to find assets to match that. And what the banks love to buy as a duration matching or hedging instrument are treasury bills and short-dated notes. So there's huge appetite in the US for this type of security, particularly in a loose fiscal environment. But, and there's always a but, this is monetization of the deficit. If the banks are buying government debt, effectively America is printing money. Bank balance sheets are being used to finance the government, and that is not a good thing. It always ends badly, as we know, and that's what the bond markets are beginning to get spooked about. Evidence here, this is growth in US money supply in red, weekly data, and the orange is showing the contribution or the growth rate that's coming from bank holdings of treasury and agency securities, in other words, government debt. And that's the fastest growing part of US money supply. And that is, a warning for the future. So that's something that we've got to be, particularly alert to. What are the risks upcoming? I stated some of those risks earlier, but a lot of it is to do with refinancing of debt. This is showing the change each year in the amount of debt that has to be refinanced. And you can see that there was a big drop in the COVID years, 2021, 22, where a lot of debt was termed out because of zero interest rates. Now, when I began my career, I worked for an American investment bank called Salomon Brothers, which was the big fixed income investment bank worldwide, and Salomon Brothers Research Department, which was one of the most thorough, rigorous research departments on Wall Street, used to look very closely at a book called The History of Interest Rates, which was written by one of their alumni called Sidney Homer. And that book looks at 4,000 years of interest rate history. Nowhere in those pages was there any evidence of zero interest rates. So what we had, and we actually even got to negative interest rates in some places, what we saw in those years was completely unprecedented. And it's creating problems for the future because it is incentivized this debt take-up. What you can see in the red bars in the future of that chart is the size of the annual debt rolls. And that is going to be a struggle for liquidity to cope with. So central banks either have to sit back and take it on the chin and see liquidity fall away, or they've got to start injecting more liquidity, which is more monetization, which basically is the reason that the gold market's going up and why bond yields are selling off. Will we get a crisis? Well, consider this chart. This chart is looking at the ratio between debt and liquidity in the world economy. This is the equilibrium or the balance that everyone needs to look at or think about. It's not the debt GDP ratio, which I think is a fairly meaningless statistic. This is looking at the ability to refinance debt. So it looks at the debt to liquidity ratio across the advanced economies. That ratio averages about 2 times, as you can see from the dotted line. If you're significantly above that 2 times ratio, you get financial crises. Every financial crisis that I can think of, and I've annotated there, has been first and foremost a debt refinancing crisis. So there's been an inability to roll debt over, and it's caused the central banks to come back and inject more cash into the system. If you go to the other side of that threshold, if you're at the lower percentages, what you find is there's abundant liquidity, and that tends to mean asset bubbles. And I've labeled the asset bubbles there. We have been in what I've labeled the everything bubble. So essentially everything is going up, be it real estate, be it gold, be it equities, be it cryptocurrencies. But that may well end, and you can see in the projection period that that line goes up. And that line goes up largely because of the debt burden of refinancing that we just looked at, and the fact that you've got cash coming out from things like US CapEx spend, which is draining money from the big tech companies. What is the way of understanding this particular crisis risk? Is to look at this chart, and what it says is the paradox in modern finance is that debt needs liquidity for refinancing, but liquidity needs debt as collateral, high quality debt as collateral. And what you can see on the 2 wings of that is the ability or the frictions that stop debt being turned into liquidity, and the frictions that stop refinancing, in other words, liquidity being turned into debt. So if you look at the left-hand side, which is probably the more immediate one, you've got to focus very much on the repo and collateral markets, because so much liquidity is being driven or is based on collateral. So collateral, as I said, is fundamentally some form of asset backing, but it's in principle, or in practice rather, it is things like US government treasury bonds, or it's German bunds. And those are the pristine collateral in the system, tier 1 assets. So the way to monitor that is to look at things like this. This is showing the stresses in the system in the repo markets. This spread is looking at the difference between repo rates, SOFR rates, system overnight funding rates, versus Fed funds. And you can see that when you get beyond the upper tram line, there are increasing tensions in the system. Now, so far, the Federal Reserve has reacted by injecting liquidity back into the system to keep that spread down. But as you can see visibly from the chart, we're getting more and more evidence of it beginning to break through the top of the ceiling. And that's why there's more and more pressure on the central banks to try and control this process. One of the things they've been more successful about is curtailing volatility in the system. And this is looking at the volatility across the US Treasury curve. In other words, it's bond market volatility. And the way that I read that chart, which is shown as an index, is to knock a 0 off and to say, well, okay, a reading of 100 is actually on average 10% volatility in bond markets on average a year. So a very simple way, a crude way, but simple way of doing it. And what you've got is a successful return of that bond volatility back into the normal zone. So that's comforting. Why is that important? It's important simply because in a world of collateral, you need low collateral volatility. In other words, bonds must be stable. If they're not stable, then there'll be a bigger haircut that the credit provider will demand of the borrower on that collateral. So in other words, rather than saying you face a 2% haircut in maybe a normal time as security, they will demand an 8% or a 10% haircut. And that will mean that collateral multiplier drops. And you can see from this following chart, the collateral multiplier, which is effectively measuring the leverage in the system. And that is shown as a change in orange. And the black line is the inverted reading of the move index. So if the move index that we just saw is getting lower, moving, in other words, to a low volatility environment, what you're seeing there is that black line moving up on the page. And that is saying that we're getting more leverage generally within the system. And that clearly is an important point to consider. Take the US Treasury market. Is it stable or is it not? People are very, very concerned right now about the bond market selling off. I think there is, too much concern about the US Treasury market and maybe not enough concern elsewhere. But if you look at the US Treasury yield, which is shown there in orange, that is the most important security price worldwide, the yield on the 10-year US benchmark Treasury bond. And what that shows is, I think, over the course of this year, stability. And that's one of the things that we need to think about. Now, I can pause there to see if you've got some questions. Otherwise, I can explore more about this whole bond risk that people are talking about.
I mean, not long ago, I had an expert in an interview and we talked about 10-year yields. And he basically said, well, all the United States have to do is stop issuing 10-year bonds. And the moment they stop issuing 10-year bonds, the yields won't go up. And I think you argue as well that the real yield, if they didn't increase the calendar so much to the short end, would be way higher. So my question is, maybe the 10-year isn't that important anymore, and maybe the short end will be way more important.
Well, I think that's correct. I mean, what you're saying is absolutely right. The fact is that what you've got is generally stability in the collateral markets, because if there is more short-dated debt to use as collateral, that by definition has lower volatility than a 10-year bond. That's the reality of the fixed income market. The more you issue at the short end, the more that you are going to encourage low volatility in your collateral. So there is a benefit there for sure. And I think your previous guest was absolutely correct, maybe in his suspicions, to say if the US Treasury doesn't issue so many coupons at the 10-year tenor, then the yields are not going to be going up so much. And that's exactly what they're doing.
Well, I have a very, very basically the more I read, I really carefully read your book many times, and the more often I read it, I basically come to the conclusion, and as well when I read everything you publish, I come to the conclusion that basically we have two opportunities. Maybe when you go to the chart of the debt wall, the refinancing wall, where you say that basically in 2025 to 2027, a lot of the debt will be due. Normally, the way I see it, there's two opportunities, isn't there? Either they increase liquidity to refinance it and they monitor it, like you say they carefully monitor it when you look at the spreads and when you look at the move index and so on. So is it true that policymakers have two options, either to increase liquidity to prevent a crisis, or just go straight into the next crisis, and basically this all about whether they will do a policy mistake, which will be not increase liquidity sufficiently to not have a crisis? Because if we get a crisis, we all know that they will have to increase liquidity by even further, because every crisis was matched with a very, very, very sharp increase in liquidity.
Yes, I think that's well put. I mean, the fact is that what we know is that I mean, effectively there are two choices. You can either default the debt or you can monetize the debt. If you default the debt, the whole financial system implodes, because effectively we live in a credit world. So one person's debt is another person's asset. So from that perspective, you simply cannot default the system because the whole financial balance sheet would disappear, and that clearly is something which is an uninviting prospect for any policymaker. So the ultimate solution is they've got to monetize it. And what that means is basically adding more liquidity. Now, I think the question that is an important one to ponder is, what do we really mean by monetizing? What we mean by monetizing is basically printing more money in the denomination of the debt. So in other words, if there's US dollar debt, we need more US dollars in circulation, etc. If there's more euro debt, we need more euros. Now, does that mean you get high street inflation? The answer is not necessarily. You may well do, and that's, I think, a clear risk. But if you go back to the 2008-9 global financial crisis, there was a huge amount of liquidity created, but it didn't really come through in size in the high street. So you've got to differentiate monetary inflation from high street inflation. They're very different things. Clearly, high street inflation matters more for most of the public, most of the voters. And what happened after the COVID crisis was money was injected directly into the real economies, and that caused high street inflation to explode. And that's one of the things I think a lot of politicians are now suffering. And arguably, that was the reason that Biden lost the election in America, because Americans were so fed up with higher prices. And I think that's a reality. So I wouldn't necessarily say that this monetization, which is inevitable, is necessarily going to lead to high street inflation. It probably will. I mean, I'm not going to hide from that fact, but it isn't necessarily the case. But it will mean asset price inflation, because asset prices are much, much more sensitive to monetary inflation than consumer prices.
I would say 2008 until maybe 2022 were actually perfect, because they could increase liquidity, they could kind of increase it, and inflation, mainstream inflation like CPI inflation, supermarket prices, and so on, what you call as high street inflation, wouldn't pick up. I think it's maybe a different situation right now, because we have this geopolitical tensions rising. We have supply chains that are not as constructive as we have seen during COVID. We have the United States that want to bring back a lot of the industries to America, so the reshoring happens, and all that, of course, will increase prices as well. Tariffs might increase prices. So in the end, I would assume that policymakers have to take a decision, and that decision is, can we accept higher Main Street inflation in case it occurs? Let's say we don't know whether it will occur, but if it occurs, do you think they then have to just swallow it and say, okay, the new inflation target is 4%? Because they don't really have a choice, because if they don't increase liquidity, like you mentioned, then there will be a deflationary crisis. And once we have a deflationary crisis, you said 80% of the lending is collateral based. When the collateral goes down, then you get a crisis that you can only get out by decreasing the currency. It's always the only way out. So in the end, if they are faced by this choice, what do you think they will choose?
Well, I think what they'll choose, what they've chosen every time for the last several thousand years, is they monetize. I mean, that's the only solution. They have to print money. I mean, that's the only way ultimately out of debt. And you either default it, you get deflation. Deflation is unacceptable. So you've got to print money and effectively have inflation. Now, inflation is unacceptable to some, but it's probably least bad. Certainly for the political classes, it's the least bad option, and that's probably what they're going to choose. So I think that will be the inevitable choice for sure. But I think we've got, there are challenges in between that. And I think one of the challenges, which I'm going to show now, if you can see that chart, is looking at what's happening in terms of bond markets worldwide, but particularly what's happening in the European bond markets. Can you see that? Oh, no,
Yep.
Okay. So that's looking at a wonkish concept called term premia. Now, term premia, think of it as the risk premia on a sovereign government bond. That's the best way to understand it. And this is the main way of valuing bond markets worldwide. And what you can see are a series of lines. The upper line, the orange dotted line, broken line, is the term premia, the risk premium on French government debt, OAT bonds. And you can see the direction that's going in. And this is looking at daily data from the beginning of this year. So there's clearly a problem going on, because what you've seen is almost a 1 percentage point rise in that term premia. The British gilt market, the black line, is in no better shape. It's going the same way, and that clearly is a problem. If you look at the three major, more robust bond markets at the bottom, which is the US Treasury in red, the German Bund, which is basically shown there as the orange line, and the JGB market, the Japanese government bond market, which is shown there as well as the dotted black line, those seem to be more stable. It's true that the Bund market, if you look back to February, March of this year, took a step upwards when the debt brake was released. But actually since then, bunds have been broadly stable. There hasn't been a great deal of panic. But the real problem areas are the French OAT market and the British gilt market. And that's really where I think you're going to start to see a lot of pain being taken in the next few weeks and months. And that's clearly a problem. How does France get out of that problem? Maybe France gets out of the problem by forcing the issuance of euro government debt, euro-denominated government debt. They can hide their problems. But ultimately, there will have to be some sort of bailout. This is unsustainable. The market realize that. But, moving away from Europe, I think there's more stability in the bond markets currently than people say, because you look at those term premia, particularly for Japan and for the US, they look pretty stable. And that's despite the fact that every day you hear headlines going in the FT about the Financial Times about how, Japanese bonds are selling off and it's the end of the world. Not necessarily yet. So that's, I think one thing to contemplate. The other thing to look at is to look at what's happening in Japan. And this is again slightly wonkish, but this explains the process. These are different tenors of term premium in Japan. And the red line, which is sort of shooting upwards, is the long-term bond in Japan, very long-dated government debt. Now, what you're seeing in Japan is a significant dislocation in one area of the market. So Japanese investors are shunning long-dated debt because they fear higher inflation for sure, but they're switching into equities. So this dislocation in the bond markets in Japan is much more a switch into equities or inflation-sensitive assets than it is really a dumping of Japanese government debt. So again, the media, I think, is giving you the wrong answer in many of these cases. Now, what I wanted to do was to say something about China, because this is critical to the monetary inflation outlook. This is the Chinese bond market. Looks remarkably different from everywhere else because China's been suffering deflation. What you can see there is the yield on the Chinese government bond starting to break higher now, but it's been in the doldrums for many, many months. And the term premium in black is similarly breaking out. And that is saying that there's an increasing appetite for risk in China. Now, what is China's problem? This is China's problem. We looked earlier on at the debt liquidity ratio for the world, and we noted that the everything bubble period had that ratio at very, very low levels, but it was climbing. China's is almost the mirror image. What China has suffered in the last decade is a very high debt liquidity ratio. So what that should have told us was that China is suffering from refinancing tensions, and it basically was facing a deflationary problem, and that has clearly emerged. So China has to get that debt liquidity ratio down. They have the same choice as the West has. They default or they print money. They're not going to default because that would undermine the integrity of the financial system, so they have to print money. And what you're starting to see is that evolution underway. One of the ways to gauge that is to look at the yuan gold price, not to look at the dollar yuan cross rate, but to look at the yuan gold price, because gold is a real asset. And if the Chinese are printing money, what they're trying to do is to reduce the value of paper money in China, because that's where their debts are clearly denominated in yuan. So they're trying to get the value of the yuan down against real assets. Gold is a real asset, so let's think of that as a benchmark. And what you can see here is the yuan gold price is breaking out. Now, Shanghai Gold Exchange is now the major physical gold exchange in the world, and I think they're setting the price. And what you're starting to see is the potential for the gold price breaking out of that narrow corridor it's been in, similar to what happened back about a year, 18 months ago, when it broke out again from that 14,000 level. It's now breaking out above 24,000. So that's a critical thing to watch, and that will translate into higher bullion prices and silver prices in the West as well. So that's clearly critical. What is China doing in terms of monetary expansion? This is the annual change in liquidity of the People's Bank of China. They had one flurry of liquidity injection you'll see in 2024, which is pretty much coincident with that expansion in the gold market there. And what's happening is it's underway again. So that would suggest that what you're also likely to see is another breakout of monetary inflation hedge prices in these economies. And if that happens, what's the normal end game? The normal end game is that commodity prices start to pick up. And this chart is showing you Chinese liquidity, which is the orange line, projected in orange, dotted in the orange broken line there. And the black line in both cases are commodity prices. The solid one includes energy. The broken black line excludes energy prices. And what you can see is that Chinese liquidity matters hugely for the commodity markets worldwide. If China is expanding, commodity prices are going up, and I think that's probably underway. So my investment strategy right now is to say, look, we know we're late in the game. This is towards the end of the cycle, but what you're seeing are all the normal signals of the late cycle movements. You're seeing small cap outperform. You're seeing international markets outperform. You're seeing the dollar weakening. You're seeing yield curves steepening. You're seeing bond markets suffering. You're seeing credit markets beginning to hit their peaks. And you're beginning to see commodity markets picking up. What's more, within equity markets, you've had the technology phase. You're probably towards the end of the financials phase. You're getting the commodity gold mining stocks phase that is coming through. And despite what economists say that this is, a very unusual period and, they can't understand whether it was a recession or boom or whatever. Fact is, it's a very normal liquidity cycle, and the investment cycle is absolutely on track for a normal cycle. Everything you see in the investment world is absolutely normal. That's the fact.
So there's like two big questions I have. On the one hand, let's start with maybe the most important one. You say it's a normal liquidity cycle and we are getting towards the end of the cycle. I just ask myself, how can liquidity be decreased if all the debt is going to be due? Because we have the debt refinance wall, and you say because of the debt refinance wall, there is a lot of struggle. So there could be a crisis, but every crisis we've seen was very, very short-lived. Like we only had very, very short-term crisis because whenever there was a crisis, they immediately had to devalue the currency to get out of the crisis. So how can we have another period? Because when I see the last liquidity downturn that you've just highlighted here of 2022, I think there wasn't a lot of debt coming due in 2022, was there? So in 2025, 2026, and 2027, there will be a lot of debt coming due, like you said in the chart before. So my question is, do you think we really see a 1 year cycle with liquidity being decreased like in 2022? Or do you think, and that's very interesting when you look at Bitcoin normally always went parabolic this cycle, it didn't go parabolic, but it was a little bit like gold that you just see with China. Whenever liquidity was increased, Bitcoin stair-stepped slowly higher. Then there was a little liquidity correction, Bitcoin corrected, and then it stepped higher. But we didn't get that boom cycle where it would just skyrocket. And maybe that is somehow related to the liquidity being slowly increased, but not too much. And now my question is whether with the 1 year recycle, with the increase in the 1 year issuance, maybe we change in the cycle that it will just slowly increase. Or when do you see the opportunity in terms of the debt coming due for policymakers to decrease liquidity for a prolonged period of maybe 1 year or longer?
Well, I think these are all good questions. I don't fully have the answers to those. But what I would say is that, this chart is looking at not the absolute level of liquidity, it's looking at the momentum of liquidity. And it isn't necessarily the case that liquidity will fall in absolute terms. The growth rate may just inflect, it may slow down. So that's one thing I would say. So let's not think too much about absolute drops, think about relative slowdowns. And that maybe is the worst it gets. Now, if you're a policymaker, what your major priority will be is, number one, this is in order of practicality, the integrity of your government bond market. So if you start to see your bonds selling off, you're going to have to do something, because that is really the thing that focuses attention, not inflation or employment, contrary to what the media would say. It's about the integrity of sovereign debt. So if there's a problem in the debt markets, they'll bail out quickly. If there's a problem in the sovereign debt markets, it really means there's a problem in banks by definition. So what you're going to get is an immediate bailout. That's number one. Number two is there may be an inflation concern in the high street. I don't think there's one yet. I think it's very difficult to know what the inflation outlook will be because of tariffs. But generally speaking, I would expect inflation to be not a serious problem in the next few months or maybe next couple of years, because what you really need first is commodity markets and particularly energy prices to pick up, and they're not yet. So that would be a factor. You may get a slightly higher average level of inflation. So in other words, it may not be 2%, it may be 3% or 3 and a bit percent or that sort of magnitude. But I think the politicians will bury that. It'll all be sort of down to special factors. The central banks won't change their 2% targets because that's too political. They'll just keep going as they are, and they'll try and sort of sweep things under the carpet. So I think you've probably got a benign environment. So that would suggest that central banks are going to find it difficult to justify a lot of tightening, maybe in the next 6 to 12 months. So what you're looking at as other endogenous factors that could cause a slowdown in liquidity. And the main thing, in my view, is this debt refinancing wall, and possibly the other being the technology spend, which is taking money out of financial markets. Those are factors that are clearly important. Now, what will happen if you start to get problems? I think if you get problems, you will see central banks beginning to add still more liquidity. So they'll make errors, if you like, errors by adding liquidity and fueling future inflation. But I think they're going to have to do that because of potential dislocations in the markets. So I think next year is a year where I'm not saying you're going to get a crash in prices. You can never really predict that. But I think the central banks are a lot more alert now to the risks of some sort of financial disaster, because collateral is so important to the system. So I think you'll get an inflection in liquidity, and I would be clearly cautious, more cautious than I was this year or the year before, because I think there may be issues. But is it a time to sort of bail out of markets right now? I don't think the circumstances are there yet. Clearly, if you're taking a 2 or 3 year view, you want to be cautiously exiting, or gradually exiting. But I don't think there's a reason to press the panic button right now. But let's see.
Okay, I have one more question, and then we have a couple of questions from the community. In your book, you write that actually the strange effect of quantitative easing is that it increases the instability of the system, because you say that the most important stable collateral 10-year bonds are reduced from the system, and it should be collateral for the players. But when the central banks buy bonds, then then other players don't have safe collateral, and then everybody has to increase its risk. And then the collateral that is used for 80% of the lending, like you mentioned, is more risky, and then you have more crisis later on, or more problems later on. And I think it's very interesting. Like, what we've seen in the last years was basically that we had a lot of flash crashes. Basically, every crash was a flash crash, but it never happened. Like, it always was a reshaped recovery, because then they increased liquidity. So basically, the whole game was to find out how policymakers change the liquidity issuance. So they don't really buy debt right now, like they don't do quantitative easing anymore, but they do all the other things that you've mentioned before. So do you agree with that because of all the interventions that we have, the system as a whole is getting more fragile, and therefore we will be more likely to have more of those flash crashes in the future?
Yes, I definitely think you will, but I think that's because there's this sort of nexus or vicious circle, sometimes virtuous circle, between liquidity and debt. And debt needs the paradox of the financial system is that debt needs liquidity and liquidity needs debt. And that's the plain fact of the world we live in. Now, therefore, policymakers have got to be alert to both sides of that. They've got to make sure that there is sufficient liquidity, and they've got to make sure there's sufficient good quality collateral as debt. And that may be a difficult ask, given that politicians or policymakers are not very good at many things. But actually watching that balance is probably asking too much of them. But I think they are trying. I mean, that's for sure. But there still could be a cycle, and there could be problems. And that's why I think it's very important to monitor things like the stability of the bond markets. In other words, the MOVE index and the repo spread. I think those are sort of critical indicators that people have to watch. But, generally speaking, what I was saying in the book, which was admittedly written just before COVID, was there may well be a shortage of good quality collateral in the system. In other words, a shortage of safe assets. Well, I mean, to be perfectly frank, there's now an increasing supply of safe assets, because what you're getting is people like Scott Bessent increasing, as we know, the amount of treasury bills and short-dated notes in the system. The difference is that whereas it was the central banks that were buying that pre-COVID, and actually maybe through COVID, what they're leaning on now is the banks, the private banks, to do that. Now, that's still debt monetization, but it's not the left hand, it's the right hand that's actually doing it now. They're pushing the banks, and that's why changing things like the supplementary liquidity ratio, changing stress tests of the banks, all these sorts of things are very important in terms of the future. And, what you're getting is basically monetization. That's why gold's going up. Plain and simple as that.
Okay, now we have 3 questions from the community. Given that liquidity leads markets and moves prices and is cyclical, what are your thoughts on a buy and hold approach as a solution to the ups and downs of the financial markets? To what extent should an investor rather adapt their portfolio to the cycle of global liquidity? I think I can even highlight the question here so you can read it as well.
If I stop sharing,
Yeah, I just, now you should see it.
Hang on a second. Let me see if I can see that. Yes, here we are. Given that I can see it now. Yeah. And moves. Well, I mean, the answer is what it really comes down to is buy and hold over what time period? I mean, that's really the question. I mean, the whole ethos of modern finance theory is completely wrong, because it focuses on risk and return. And risk and return are not things that we have any say over. We have no control over risk and return. Okay, it's a nice theoretical concept, but I can't decide that, right? The only thing I can decide, or you can decide, or anyone can decide in their portfolios is the time horizon we invest over, okay? So if I've got a time horizon of 5 years, I'm going to choose assets with a lifetime or a duration of about 5 years. If I've got a 30-year horizon, I'm going to have a 30-year horizon. And that's really the decision variable. So that's how I would tend to think about that. Now, let's choose, first of all, the investment horizon. which means we choose our asset classes, the sort of things we want. And then what I would do is basically use a trend following approach. And that's why if you look over the last 30 years, strategies like trend following, CTAs, have hugely outperformed value investing. But you won't find very much in finance textbooks about trend following. I mean, the only comments you'll ever find are sort of disparaging comments about how this is completely bogus. But it's been the way you made money. It's about momentum, and momentum is driven by liquidity. So that's what I would do.
Yeah. Then we have one more question about Fed interest rates. What do you see? Because you mentioned already that you don't see inflation to be too high, but in case the Fed doesn't lower interest rates, maybe because inflation is too high or because they don't see any reason to do that, do you think that's a big risk for liquidity?
No, the two are very separate. Liquidity is about the balance sheet of the central bank, the amount of liquidity in the system, and interest rates are really a different lever. I'm not saying interest rates are unimportant. I mean, clearly they're an important signaling device. But at the end of the day, I mean, let's consider or ponder this whole question that's going on in America now about the integrity of the FOMC and Fed governors. Does the FOMC, the interest rate setting committee in the US, really matter? Or does the Federal Reserve matter as an institution, as a policy-making vehicle? Federal Reserve matters hugely, right? Because the Fed balance sheet, bank regulation, all these things are really critical. Bailout, swap lines, these are all critical elements in the armory of monetary policy. But the FOMC pontificating about whether they're going to put Fed funds at whatever the number is, 5%, 4%, 3%, I don't think it really matters. In actual fact, when you look at the data, the best forecaster of Fed funds decisions is the 2-year bond. That's what it always gets at first. The Fed follows the market. It doesn't lead the market. So just look at what that two-year note rather is doing, and that will give you a guide. I don't think there's a lot of scope, having said that, for rates to come down, in normal economic grounds. I mean, maybe you can see 100 basis points off in the next 12 months. That's entirely possible. But the trouble is becoming more and more political. That's it.
I think this is a good question. If you recommend tilting a portfolio towards monetary inflation hedges, what are your thoughts on diversification in general? Should small caps, value stocks, and the like still be included in a portfolio, for example, or is diversification dead?
Well, I mean, the answer is that small caps, the rationale for small caps and value investing is that basically what you do is you buy low PE stocks. And I mean, the reality is that, let me answer it in a different way. Value investing assumes you've got perfect liquidity, right? And that's saying that cheap stocks will basically go up because there's always liquidity that can buy them, okay? The reality is that that's not the case. And the liquidity cycle is a cycle, and you get waves of liquidity. Now, what I would say is that generally, and let's talk about PEs for value investing first. Actually, in an upswing of liquidity, you want high PE stocks, not low PE stocks. In a downswing, you may want low PE stocks. So that's really the contrary view of what value investing is. Small cap is all about liquidity as well. And small cap should do well when there's abundant liquidity, but by definition, that's at the top of the cycle. And it may be a very small window. So the fact that the small caps are running now is indicative of the fact that we're very late in the cycle, right? And I can assure you that when we get to the bottom of the cycle, small caps will not be a great performer. They'll be destroyed. Your value will be destroyed in those, or your investments will be destroyed. So should they be part of a normal investment portfolio for an average investor? In my view, no, absolutely not. I mean, if you're a speculator, by all means, go for it. Buy gold stocks or mining stocks or whatever. They're very, very speculative stuff, and they'll do fantastically well in this sort of market right now. But over the long term, no. What you want is you want to think about large cap stocks and you want to think about, things like crypto and things like gold and precious metals. And although I often tell this story, and clearly there are unfortunate associations with this, but it's a very interesting insight into psychology and what you should own. And if you think of what happened in Germany in the early 1920s, it's a very interesting lesson in investment. And during that period, just around the time of the hyperinflation, the older generations were wedded to German government debt, and that's where they had most of their wealth. The younger generations were saying, oh no, we want to have inflation hedges. We're going to put money into stocks, right? Now, the stock market rocketed in Germany through the 1920s, as we know, and there was a huge wealth transfer from the older generations to the younger generations through that decade. And it's very similar, I think, now to what people are saying about crypto. Very similar arguments. People are saying, oh, this is crazy. These things have got no value. But they said that about companies, equities in the 1920s. The traditional investments then were bonds. Now it's a 60-40 portfolio with lots of value investments in it. And what you should be thinking about is thinking outside the box, and maybe how in this world of excessive debt, that debt needs to be refinanced, and monetary inflation is here as an embedded part of policy. And that means the traditional 60-40 mix just won't work.
Do you think there is a limit to currency devaluation? Because when you look at the dollar index, you compare it to different currencies. I would argue the dollar is just the cleanest shirt in a dirty laundry. So everybody does the same. When you look versus, like you did, if you look versus gold, you see, oh my God, can gold really go up like 60% in a year? No, the currency went down. But you see as well that there's collateral damage, like real estate prices escalating, young people feeling they can't have housing affordability, asset price inflation, stock market bubbles. Like there's so many negative consequences. All the polarity you get politically from the rich getting richer because they own those assets and so on. So do you think there is a limit towards how far policymakers can devalue the currency? And if so, where do you think the limit is and what happens next? Do we get some kind of currency reform or?
There are social limits, and those are social limits meaning that society can't tolerate those wealth divides and that inequality over the long term. You can see that, I think, right across Europe right now that's beginning to emerge. And I think policymakers are facing some huge challenges. I think inevitably wealth taxes are going to be an increasing part of the equation across Europe and maybe the world. So that will be one way to alleviate that problem. And therefore, one needs to be very thoughtful about how one holds one's wealth looking forward in that regard. How far can they devalue? Well, they can keep devaluing, of course. Just look at the gold price. Since 2000, the gold price is up over 12 times. And that's an important thing to think about. So, and over that same time horizon, US government debt has increased by a very similar magnitude. And that, putting those two things in the same light is educational. It shows that what's going on. Debt is escalating. And the fact is that ever since COVID, but since the GFC and COVID together more accurately, the level of government spending run across the West has taken a step upwards, and people haven't realized this. It has to be paid for. The tax revenues haven't increased. Government spending has increased by several percentage points, which means we're now sitting on structural budget deficits. And those structural budget deficits have to be financed by debt. And debt has to be monetized because it will never be paid back.
Well said. Well, thank you, Michael, for your time. I highly appreciate it. Everything you do is a clear recommendation for everybody who sees that. Like, you reading your book really, really changed my, changed how I see financial markets, and you really helped very well with that. You have a perfect Substack. Yeah, great recommendation, and thank you for your time.
Thank you. If people want to read it, it's Capital Wars Substack. So let me flag that. But thank you, Balthasar.